Jim, welcome to Marblegate.
Thank you. It's good to be here.
Over the past several years, you and I have compared notes about what we're seeing in markets and the work that RapidRatings is doing currently, then and now. Maybe if we start just there and you could describe a little bit about RapidRatings and how you all run the business and how you look at companies.
So RapidRatings is at its core an algorithmic system that evaluates what we call financial health of public and private companies around the world. And we do that by absorbing financial statements of companies in order to be able to see very deeply into what's driving the company, what's going well, what's not going well. And we do that looking out multiple years as well as a one-year default probability-oriented component to the scoring. So with all of that, we have the ability to understand how individual companies and cohorts and industries look. We do this for clients who are evaluating these businesses because they work with them or are lending to them or buying from them. So a big portion of our client base are large industrial companies and financial institutions that are evaluating their suppliers and their vendors to understand the inherent risks that exist in those businesses. And a big chunk of those are private companies. So we can see all kinds of trends in that data. So what we're looking at and what the scoring system, the financial health rating and our core health score, what they uncover are things like what's the cost efficiency? What's the working capital efficiency? What are upstream and downstream profitability measures looking like? What's the leveraging and liquidity and resilience factors within a company? And all of that is done on an industry-specific basis. So we can have apples-to-apples comparisons of companies of really any size, public or private, across industries and across the world in a common format. And that makes it extremely helpful for people to understand what the trends look like.
Maybe if you could just summarize what the data set at RapidRatings looks like generally.
Well, what we're seeing right now, and particularly because we have so much insight into private companies, is we're seeing this separation that's been happening since really early COVID, but definitely in these couple of years sort of post the biggest impact of COVID. And that is that private companies are struggling more than their public company counterparts. Now, private companies tend to be smaller, and you're really looking at a middle market cohort of companies, not the mega caps. There are a handful of very large privates. They're very few and far between. So what we're seeing is that companies have had greater strain. I'll give you one example. The cash turn for private companies has extended out over the last 4 years by 28 days. So if you think about the fact that the strain on companies in terms of when they're getting paid and when they need to pay out dollars has been stretched, that's a really good indication that downstream the customers of private companies are putting pressure on them. And at a time when we have higher inflation, we've got higher labor costs, we've got higher interest costs, all of these factor in to making it much tougher and squeezing the operational performance of these companies at a time when they can really least afford it.
It's a really interesting observation. One of the things that we say is always a proximate cause of financial distress is working capital. So it's the number one reason that a company ultimately finds itself into a place where it has to resolve its capital structure. And at the core of working capital management is the cash conversion cycle, right? That matching receivables and payables and how we manage inventory between the two is a skill set that as companies grow in complexity, they oftentimes don't grow in skill. So it's interesting that your data is showing an increase in working capital mismanagement or difficulty in managing working capital because it mirrors and echoes the same thing that we see in the market.
Yeah, and I think it's, there are certainly companies that based on their size or their longevity, whatever it may be, they don't have the skill sets internally to be managing working capital in as sophisticated a fashion as they might like. And of course, one of the biggest components of that is just the cost of capital itself. And for the typical private company, of course, they generally are getting their debt from a bank. And the bank is, of course, floating rate. And the rates being significantly higher today than they were probably when some of these facilities were put in place a couple of years ago makes it very difficult for the companies to manage through that time.
In the paper that RapidRatings and Marblegate produced together, we looked at debt service coverage ratios. That is the ability of the company to meet those obligations given their cash flow. And I think one of the more dramatic outputs of that paper is the sharp decline over time in the average debt service coverage ratio in the data set. Whereas in the 2023 data set, we saw that debt service coverage ratio was right at 1 times, with a full quarter of the data showing companies below 1 times.
That's right.
Meaning they just can't pay their bills.
It's not a surprise that both operating margins and absolute operating profit levels have declined. Each one of these companies is trying to manage a business, trying to pay their employees, trying to deliver on time and to specification for their customers, and trying to put themselves in a position where they can refinance the debt that they originally had.
We see validation of this observation outside of the RapidRatings data set as well. So in the most recent Shared National Credit Review, the Federal Reserve looked at $6.4 trillion worth of bank commitments, non-commercial real estate, and found $570 billion worth of criticized assets on banks' balance sheets. That is, those are assets that the Fed is saying you're not likely to get par back on these. And so when we look at that dramatic rise in criticized assets, and by the way, this is the highest recorded level of classified assets since the great financial crisis. So we find this like dramatic stress in the system. The fundamental data is showing it. And so we see all of these inputs that are telling us there's a real weakening in the system. Contrast that maybe with what's happening in public markets.
Well, I think there's the hopeful public markets, and then there's the reality under the surface. The public markets, the larger companies, are very different than the private companies, and the differences in their performance, the differences in their access to capital, differences in their resilience to all of these more volatile factors is significantly greater. So when one looks at the S&P and you see period after period of record-breaking numbers, that is one aspect of the market, but it's the easiest to understand for most people, and it's the easiest to see. Underneath that are the companies that support the Fortune 500 or the S&P's names, and those companies are the ones where the greatest strain is truly affecting them. Every public company is reliant on private counterparties. Across our client base, again, Fortune 1000 type companies, about 75% of their supply chains are comprised of private companies. Criticality of their supply chain is driven by the private companies they're exposed to. So what's affecting private companies is critically important to every public company. It's just not talked about as much.
And those public companies, how is it that they're able to exercise, ongoing profitability growth and ongoing success in capital markets? Their stock prices are going up when it's just crumbling beneath them.
Well, I think it's who's got the leverage, who's got the power, and the larger companies have that. So, if you're a smaller private company in the middle market and you're suffering from all of these challenges, you don't solve them by turning around to your large public company client saying, hey, guess what? You're going to pay 30% more now. So the public companies, the larger businesses, still have the balance of power on their side, and they've been able to run with that for a long time. Access to capital, again, being absolutely one of the biggest that we see. So the larger public companies have multiple sources of capital, whether it's public markets or private markets. And the smaller private companies, you go further and further upstream into the more private and more small companies, tend to be bank reliant or to some degree aspects of the private credit market, which of course has been growing and exploring how and where it fits in this ecosystem.
So Jim, thinking a little bit more about the difference between the public market companies and private market companies, could you put some context around the scale of the difference in financial distress or troubled performance in private world versus public?
If we look at the data in the papers that you've just produced, we see on the public company side, approximately 15% in what we would call high risk and very high risk. So the FHR and core health scores are produced on a 0 to 100 basis. 40 and below is where high risk and very high risk exists. Over the last 20 years, well over 90% of companies that have filed for bankruptcy have been at 40 and below. So it's a pretty good demarcation of what's important on the scale for more immediate attention. In contrast to that public market, 15%, the private companies are at 36%. The contrast between public and private companies is really quite stark. So for instance, on an EBITDA level, the private company cohort was down over the 2019 to 2023 period by 39%, where publics were up by 16%. That's just operating profit. Net profit, private companies are down 233% to public companies being up 27%. Leverage for the private company cohort was up almost 140%, while it declined 9% for public companies. And then interest coverage is down 70% over that period of time. You put all of that together and you see that there is a strain from the very top in private companies all the way through to the net profit line. And a lot of that pressure is coming in the form of inability to cover interest expense and the spiking cost of capital.
Yeah, that's a dramatic difference. And it, again, consistent with what we see from other sources of data. It seems like only a matter of time until the reality of that difference and the reality of that credit underperformance, sort of the rubber hits the road and somebody is forced to do something about it.
Well, absolutely. But even in the Chapter 11 statistics for the last year, we've seen approximately a 9-to-1 ratio of private companies filing versus public companies. So that also kind of tells the story. Just that strain is a lot harder to live with for an extended period of time for a private company than a public. And we're seeing a lot more private companies hitting the end of the road.
It then also starts to explain the differences we see in pricing in private companies coming out of bank-financed context versus the public markets, which are leveraged loans at all-time high prices, credit spreads at all-time lows, and we see the sort of ticker tape economy flashing green, while what you see, what we see, what federal bank regulators see, what the bankruptcy statistics see, are a real underperformance in these middle market. You know, and that net profits after tax statistic, I think, is super compelling, and it's a very important point to make in a private market context. Those companies are either owned typically by smaller sponsors or families, where cash flow and net profits after tax are critically important to the ongoing survivability of those companies. For these companies, they oftentimes need the tools of financial restructuring in order to put themselves back into a place of sustainability and survivability. And is there anything in your data, or as the team at RapidRatings looks across the market, that says we're likely to see some arresting of this trouble in the credit profile?
Well, it's sort of a race against time for a lot of companies, because you can think of, I'm sure you do, think of liquidity as a fuse life for companies. And if their operational performance has been impeded for one reason or another, but in our terms, their core health is deteriorating, then the length of time that they have to fix that problem is very much dependent on how much cash they've got or how much access to liquidity they have.
Well, Jeff, this has been an excellent conversation. I really appreciate you coming in and spending time with Marblegate today.
Absolutely. Always enjoy it.